Welcome to the Commerce Lab, where every week we sit down with top-performing consumer brands and leaders to understand what drives their success. How did they hit their first million, their first 20 million, their first 100 million? What strategies are working for them today that you should be testing, and what's not working that you should be avoiding? This isn't just a podcast. It's the business school for brand operators. Hey crew, welcome back to another episode of the Commerce Lab. My name is Alan Burt, and today we are doing things just a little bit differently. We're going to be talking about taxes, right? As everybody's eyes just instantly glazed over. But they shouldn't, because literally what we're going to be talking about today is areas of opportunity for you to save cold hard cash, and in some cases, significant amounts of cash. And before we get into the details, I have to give a disclaimer. I am not a tax professional. I am not a CPA. Everything we talk about on today's episode is purely sort of advice that is coming from an interview with an actual CPA, and it's all things that you should consider, but ultimately need to talk to your own tax professional or accountant about before implementing yourself. So, with that disclaimer out of the way, I brought on a friend of mine by the name of Dan Nicholson, and Dan is the owner of Nth Degree CPAs. He's an incredibly gifted entrepreneur, incredibly gifted CPA, and also has a background in e-commerce. And what we did today was actually break down a few critical things that you need to be considering as the owner or operator of an e-commerce business. One, there have been some major changes into the tax code over the last couple of years. One, with the way that Nexus is handled at the state and local level. What that means for you, the triggers and the thresholds for having to collect sales tax at states that you sell into is incredibly low. Really, really low. And the fact that if you're operating a 7-figure business or 8-figure business, I guarantee most of you are triggering Nexus in a lot of these states, since you need to be looking into it. We also look at inventory. How are you classifying inventory on your books? The way that you are able to classify that has changed over the last couple of years to your benefit, and there's actually a fair amount of tax savings there if you're not classifying that correctly. And then the second part of the conversation was a little more fun in the sense that we dug into areas of opportunity that essentially any business owner, especially a 7 or 8-figure business owner, has to reduce their tax burden, and in some cases, save anywhere from $50,000 to $100,000 plus a year in actual cash that you're currently spending on taxes. So we broke down probably about a half a dozen different techniques, ranging from reasonable compensation study analyses, the Augusta tax loophole, probably my favorite one that you should absolutely listen to the episode, if nothing more than to just hear that one, and a few others as well, including ways to structure your business, or how your business should be structured as an entity, LLC, S Corp, C Corp, if you want to sell it. There's a couple of different, ways to structure your company and reasons to structure it differently depending on how you operate. If you're currently operating profitably with a, high profit margin, you should be, this sort of structure. If you're currently operating at close to a zero profit margin, you should actually be structured a different way, because you could save an upwards of $10 million at the point of sale when you sell your company if you structured it correctly. Essentially, in some cases, actually reducing the amount that you pay in capital gains tax to zero in certain scenarios. So make sure you listen to the episode. We get in pretty nitty gritty and go through the details. So we tried to give you enough, try to keep it high level enough so that you can understand it without being a CPA, but also give you enough details so that you can understand the nuances of how and when to apply these, so that when you go out and talk to your CPA or to your accountant, you could tell them exactly what you're going for. So without further ado, I'm going to leave it to Dan Nicholson of Nth Degree CPAs to walk you through some areas of opportunity for e-commerce business owners as it relates to reducing your tax burden. Hey, Dan, welcome to the show.
Hey, thanks for having me on.
So we're gonna go real deep here on sort of taxes. But before we do, I want to make sure everybody has a little bit of background on who you are and what you do and sort of your qualifications to talk about this. Can you give us just a real quick intro?
Sure. Yeah. Always the kid scheming on business ideas growing up. So I've always kind of fancied myself an entrepreneur. And then I went to college and got an accounting degree, and also a degree that doesn't exist anymore, but it's called E-commerce Information Systems. So I went to a school in Seattle, and as you might imagine, in the early 2000s, they were thinking that e-commerce was a big thing. It still is. But they created a new degree that was kind of dovetailed off of just your more standard information systems degree. So know enough to be dangerous in that front, but maybe not enough to actually go build my own e-commerce platform. But got those degrees thinking I'm going to start a business, and then went in the exact opposite direction. So I went to the board that writes all the accounting standards and helped develop an accounting standard on derivatives and hedging activities, and then worked at one of the big global firms in derivatives. And then I had kind of a career and personal quarter life crisis. Like, what am I doing? This is not at all entrepreneurial. So moved around for a little bit, helped a Warren Buffett-backed company get ready to go public, worked in strategic finance with the now CFO of Roku, although I just read he's about to resign or in the process of leaving Roku. And then spent some time in tax. I've kind of done a bunch of different things. And then I realized almost 10 years ago now, hey, maybe I'm pretty good, long story long, at this whole finance tax thing. And I think there's an opportunity to start a business in the accounting space and kind of scratch the entrepreneurial itch and kind of leverage the skills that I have. So that was the basis for starting my firm, Nth Degree CPAs. And since then, we've got a couple offshoots of that as well. But that's my kind of primary thing, is working with business owners to help them kind of have financial certainty.
And the reason why I wanted to have you on the show is, we talked to, dozens and dozens of e-com brands, both through our firm Blue Stout, but just also through just sort of my networking in the industry. And I always hear very specific complaints, right? And very specific sort of concerns. And a lot of the times it's tax related, right? And there's been a lot of changes in either the tax code, whether it be sort of how states are applying sort of sales tax, changes in the tax code that enacted, what was that, 2017, I think, which was the new tax code, right?
Yep, right at the end. Yep.
Right. And so what I think would be really helpful for brands that are out there currently operating right now, if you're a multi-million-dollar brand that's operating, tax is a big consideration. And if it's not a consideration, it needs to be a huge consideration, because there's probably a ton of opportunity to optimize what you're currently doing for more profit at the end of the day. And so what I want to do is bring Dan on to talk about a couple of things. The first is, what are some of the big changes happening right now that you need to be aware of and concerned about, either because there's big ramifications for your business or because there's actually some opportunity there. And then the second thing we're going to talk about is, what are some just really easy wins, some things that most owners don't really recognize or know is even possible with the tax code, just because we're not CPAs, we're not doing this every day. But hopefully there's a few things here that Dan can suggest to help give you guys some early wins and put a little more of that profit back into your pocket. So Dan, to get things started, let's talk a little about the changing wave that's occurring right now. One, with both state, local tax, and then also with some changes to how inventory gets classified, and or at least how it should be classified, and with the changes to the tax code, recently.
Yeah. So one thing to know that's maybe a way to unify the country is that I've talked to thousands of business owners over the last 20 years or so, and everybody wants to pay the least amount in tax, regardless of their political leanings. That's like the first thing they say to me is, hey, I don't necessarily want to do anything illegal, but I want to be everything on the up and up and want to be completely ethical, and I want to pay the least amount of tax. So
right.
We all have that in common. And the challenge is that a couple things. One, the federal tax code, it's always evolving. There was the big recent change at the end of 2017, but there's also just ongoing small things that kind of change that make it difficult. And then on top of that, in 2000, just to give some context, in 2003, we had about 82,000 state and local governments. Now we have 89,000. So we've added, just over the span of about 16 years, several thousand additional state and local governments. And unfortunately, there's not necessarily a uniform set of rules. Each city, state, county, et cetera, have their own kind of wrinkles, which are especially challenging for e-commerce businesses, especially challenging in light of the Wayfair ruling that came down a few years ago that basically is allowing states, or sort of laid the foundation for states to apply their rules to e-commerce businesses in a more aggressive way. So typically there's this term, nexus. Nexus really is a term that means do you have to comply with that state or city or county's tax rules. And basically what Wayfair establishes, if you have 200 transactions in a given year in the state, or more than 100,000 in sales, that's sufficient to establish nexus. Historically, nexus has been, do you have employees or do you have assets that you're keeping in a given location that would trigger nexus, or some usually pretty high sales volume in the state. And so the 200 transactions or 100,000 is a really low threshold that just about every state has either adopted those guidelines or plans to adopt. I think there's 2 states currently that have not adopted or are not enforcing those guidelines.
So currently, like if you're doing 200 transactions a year in pretty much any state, like right now, like in this month, you technically should be paying taxes. Sales tax, if that state sales tax. Collecting
sales tax from your customers based off that local sales tax rate.
Got it.
Yeah. And to clarify the 200 rule, it's transactions, not customers. So, for example, say in January pick a state, Wyoming, you've got 17 clients who sign up for something that you're selling that where they have a recurring payment. Well, 17 times 12 is 204. You're over the 200 transactions. And so technically you now have nexus and you should be collecting sales tax. So it's not customers. You can get to that 200 threshold pretty easily if you've got any sort of recurring payment subscription type model.
That's incredible. I think I guarantee most brands out there don't realize that. And is that physical products and digital products? Is there any sort of differentiation between the two?
Nope.
Wow. Other than sales tax and collecting sales tax, is there anything else that Nexus would trigger? So you mentioned sort of you then have to apply any sort of local ruling, but sales tax is obviously the biggest one. Is there anything else other than sales tax you need to be concerned about?
So Wayfair is really specific to sales tax. We have separate rules for income tax. So you may have Nexus from a sales tax perspective, but not from income tax.
Okay.
So unfortunately, each state, again, has slightly different rules in terms of what triggers income tax. And this is where it gets a bit challenging. And I guess I should be thankful. It's a job protection law to some degree because they're so nebulous and so inconsistent. So you could have a threshold for sales or assets or some combination, and the way that they define sales varies. So one state might say it's based off where the benefit is derived that you source the sales to, and another could say it's based off where the work is done. So that creates challenges in terms of figuring out where is the actual benefit derived, or where is the work being done, and how does it vary on a state-by-state basis. I would generally say that sales tax, this whole Wayfair ruling, is a much higher in the priority list for you to assess, and that's in particular because income tax is a tax on profits, and you apportion your profits on a state-by-state basis, and then you pay tax, based off each state's nexus rules. Whereas sales tax is a tax on every sale, and so that's just a long way of saying that your sales tax liability could be most likely significantly more than your income tax.
And are we seeing when did the Wayfair ruling come through? How long ago was that? Do you know?
Let's see. I can give you an exact date here. Just a second.
And I was just curious, ballpark. And the reason why I'm asking is more so along the lines of enforcement.
Yeah, June of 2018. So
Okay.
in not much time, states have been pretty quick to jump on
Yeah.
applying these rules
Okay.
across the board. In addition to kind of these 200 transactions and 100,000 in state sales, states are also adopting different rules for marketplaces, and depending on how you've got your affiliate rules set up and click-through transaction limits, that you can trigger Nexus in other ways beyond just the 200 transactions or 100,000 in state sales. So it somewhat depends on how you've kind of structured your business as well.
And is the burden on the retailer and on the brand to be aware of this and pay it? Like what does enforcement look like? Do you know?
So the burden is on the business to enforce it. Okay. And in terms of the enforcement, it's ramping up. So there are states now who are generally giving windows for you to basically comply going forward. Sort of like, hey, I haven't necessarily been participating thus far, even though maybe I should have. Mm-hmm. Effectively, a voluntary disclosure program where you can get in and not get dinged if you were out of compliance in previous years or months. So even though there's this Wayfair ruling now, it's possible you before Wayfair you triggered Nexus, you just weren't aware of it. Mm-hmm. So it's pretty essential to jump on these voluntary disclosure programs if you're out of compliance. So do the work now, figure out where you're at, and if you can, jump into these voluntary disclosure programs to avoid getting nailed later with penalties and back taxes for years.
Got it. So that's a pain in the butt.
Huge pain.
Yeah, massive pain. So, and again, there's nothing really here from like an optimization standpoint. But I think I wanted to start with that because I think it's something that most brands probably aren't aware of how quickly this is going to become an issue. And they should be, taking actions down to make sure that they're not in a position of non-compliance and getting dinged, in 2020.
That's right. And we work with clients to strategically position themselves. So if you're out of compliance, what's the best route? How do we get the right systems and processes in place so that this isn't such an onerous thing on an ongoing basis? So there are tools out there that can help you, like Avalara or TaxJar. They do have to be configured the right way based on the business. So they're not just install it into your website and you're good to go. You've got to set up the rules. But if you invest in the process and systems up front, which I know is not an exciting thing to do by any means, but you can substantially reduce the burden of ongoing maintenance by getting the right tools.
Awesome. Yeah. And we're big fans of Avalara and TaxJar. If you operate on the Shopify platform, those integrations are incredibly easy to do in terms of integrating them, but it sounds like the difficult piece is knowing how to then set them up, right? So how do you actually know what states and you need to be paying sales tax in and whatnot? But it sounds like, Dan, that's what you guys do to help, right?
We do. Yep.
Cool. Okay. Okay. So let's kind of move on. I want to talk a little about, there were some big changes to the tax code, back in sort of end of 2017 into 2018. And one of those big changes was how to classify or sort of manage, inventory. So I'd love to kind of have you talk us through kind of what those changes were and any sort of opportunities there are for owners to maybe classify inventory differently and potentially have some tax savings.
Yeah. So effectively in the past, you are required to track inventory and you only got a tax deduction when you sold the inventory. And that was challenging because tracking inventory is a pain, maybe more of a pain or similar pain to sales tax. But also, so one, it's just a pain and no one likes doing it. But also, if you're a growing business and therefore your inventory is increasing, you've got these sort of cash flow challenges at the end of the year where you've taken your profits and used the profits to help buy more inventory. Well, now your cash is constrained, but you're paying tax on the profits where you've allocated the cash to buy more inventory. So in the past, it's been pretty challenging for scaling businesses to be able to both finance with profits additional inventory to continue to scale, but then also pay the tax on those profits. So under the Tax Cuts and Jobs Act, a couple things happened. One, the requirement to be an accrual-based taxpayer went up. So accrual is a much more burdensome accounting method. Most of us prefer to operate on a cash basis, meaning we recognize revenues and when we get paid, and we recognize expenses when we pay someone. Accrual requires recognizing transactions as they occur, not necessarily when you get paid for them. So the requirement went up. Basically, if your 3-year revenue average is 25 million or less, you don't have to go on accrual. So that keeps things relatively simple. But also as part of that, and there was a lot of debate on what does this mean towards inventory. And so the American Institute of CPAs and some others asked the IRS for clarification. Essentially, hey, if we don't have to be on an accrual basis, does this also mean now that you're saying we don't have to track inventory? And effectively what the guidance back was from the IRS is you're allowed to basically file your taxes consistent with the internal method of accounting that you use. In other words, if internally you're tracking, you're directly expensing inventory, essentially as you buy it, you're expensing it, then you can do the same on your return as long as you're not required to do accrual. In other words, as long as your average 3-year revenues are 25 million or less. So huge shift in the sense that now we can just deduct the inventory when we purchase it, which means that our profits are more aligned with our actual cash flow. So then we're not having this issue where as we're growing and we're taking on more inventory and our cash is constrained, we also have to pay tax on cash that we're not currently holding. Does that make sense?
So it does. So, and it is. I'm going to sort of summarize it because I'm not a CPA. And so, and see if I'm understanding it correctly, but it sounds like prior to the tax changes, if I were to take profits and use a portion of those profits to buy up inventory for the next year, I would still have to be paying taxes on those profits, right?
Yep.
This is prior to the tax change.
That's right.
The new tax change, you can essentially take, whatever profit used to buy inventory and deduct that expense, right? Because inventory would then just be an expense. And so you're not paying taxes on those profits because you're just buying inventory up with them, right?
That's right. Yep.
Okay. Very cool. And hopefully everybody's sort of changed, their methods of how this is being reported on their taxes. But if for some reason, if you look back and you're finding that your CPA has not made that change for you, then obviously there's probably some money hidden there that you can get back. Actually, can you refile if you've been filing incorrectly, Dan?
Yeah, you can go back 3 years to amend returns.
Awesome. Okay. So for some of you guys, if you guys haven't made that change, that's probably an opportunity to go back and kind of pull back some cash that you probably paid in taxes that you haven't needed to.
That's right.
Anything else inventory wise that's of note?
Not necessarily on the inventory front,
okay.
But also as part of the Tax Cuts and Jobs Act or tax reform, the R&D credit was made final or permanent as part of the tax code. So we've got this federal research and development credit, applies to about 37 industries, and it has to do with doing something technological in nature where you're developing a new product or process. Mm-hmm. So if you've developed a new product, or in developing your e-commerce platform, you've created some new processes or technology, there's an R&D credit, and we've seen a lot of people leave this on the table. And it's effectively a 6% credit on the costs associated with this, which includes wages and any supplies, which would be like AWS costs, any other sort of soft costs along with hard costs if you've got a product. So we've seen a lot of people leaving money on the table there. We've gone back and amended and got quite a bit of money back for the R&D credit for e-commerce folks. So I'd make sure you're aware of that.
What would be an example? Like, do you have an example of what's something that would qualify for an R&D credit?
Well, we have a client who developed a marketplace, and they developed the whole platform for it, and the process and the way that they work with their shops on the marketplace. And so effectively all of the costs that went into developing and continuing to develop their marketplace qualified as R&D costs.
Interesting.
And what's cool about this R&D credit is that for a lot of startups in the space who maybe aren't profitable yet, you can use that credit to offset payroll taxes. So you can still get an immediate cash flow benefit from capturing the R&D credit if you're not profitable yet.
That's very cool. I'd be curious to know sort of how that applies to businesses that operate on sort of existing platforms like Shopify. But my guess and my assumption would be that, the money you pay for that wouldn't qualify. But there's a lot of brands out there that are building sort of add-ons, on top of that are custom, that are, fairly intensive investments. There's a brand, for example, that I know that we work with that's developing a way for people to sort of register their product and get sort of special rewards and sort of notifications and sort of health notifications related to their product. That's completely separate. It's completely custom, app that they've built. Something like that might qualify.
That's a great example. Yeah. More likely than not, the costs that they incurred, both salaries and like I said, the softwares that they may have purchased or hosting time, that would also qualify. And depending on how they're structured for tax purposes, they also potentially might be able to include some or all of their profits back into the credit.
Interesting. So if you're out there, even if you're operating on something like a Shopify or BigCommerce, but you've done some sort of custom development work, either maybe you've developed like a custom private app that integrates into Shopify that does something very unique. Definitely something worth looking into, because it sounds like, all the investment and costs that, and salaries that have gone into that, potentially could qualify for this credit. So something everybody should be looking into.
Yeah, and credits are way better than deductions. So if you've got a $100,000 credit, that saves you $100,000 in tax.
Right. So the difference is, just for us sort of tax knobs out there. So the difference between a deduction, right? A deduction is essentially a reduction of your profits as it's sort of looked at by the IRS, right? Versus a credit, which is essentially a straight deduction on what you would, or a straight decrease in what you would pay in taxes, right? Like actual cash.
Yeah.
Okay.
Yep, exactly. Credit, $100,000 credit saves you $100,000 in tax. $100,000 deduction saves you $100,000 times your tax rate. So if you're in the 32% tax rate, saves you $32,000.
Very cool. Okay. Well, that's awesome. So let's talk a little bit about, and this is, again, one of the reasons, probably actually the primary reason I brought Dan on is, I know Dan fairly well, and Dan and his team are incredibly good at finding areas of opportunity to save tax, right? Everybody wants to save more taxes. So the real reason I wanted to bring him on is I wanted to have him talk about a few things that we would probably consider to be like low-hanging fruit opportunities. And some of these would be low-hanging fruit opportunities for any business owner, but also specifically for e-commerce business owners. And there's a lot of things changing right now. We're seeing things like increase in tariffs on sort of goods that are being manufactured overseas, and so people are getting squeezed in a lot of different areas, especially in the e-commerce space. So if there's areas for opportunity to improve your profits or save a little bit on tax to help increase that cash flow that's coming in, obviously that's a huge opportunity. So what I want to do is have Dan sort of talk through some of the things that he sees as pretty low-hanging fruit opportunities that most brands or most businesses should be at least looking into, and more in most cases actually taking advantage of, to help reduce their tax burdens every year.
Yeah, so there's a few buckets that we look at. First one is entity structure. So how we actually form the business or businesses in the most efficient way based off our goals, which could be to sell the company or to maximize how much cash we can get out. So how do we structure that the right way? And then we look at what are the available deductions and credits that we can capture, R&D being an example of that thus far. So starting with entity structure, first off, and this is a conversation we have pretty regularly with our e-commerce clients, which is how do we position ourselves for an ultimate sale and in the most efficient way. So First off, if you got multiple brands, you're likely to want to hold each of those brands in individual LLCs. It's going to make your accounting easier, and it's going to just be easier to sell that individual business. And then you form a holding company or parent company where all your kind of administrative expenses are. Chances are you're going to want that holding company to be an S Corp. Without getting into all the details of that, S Corp is basically a way to minimize the self-employment tax or the tax that you pay as a self-employed person for Social Security and Medicare. So S Corp helps you minimize that tax. Basically, you pay yourself a reasonable salary and you take the rest out in draws. Ton of misinformation out there about reasonable salary. Really reasonable salary is based off the sum of all the different hats or jobs that you're doing within your business. So it's not as simple as just going in and saying, well, what's a VP make? Chances are that a VP in quote unquote e-commerce, their salary wouldn't necessarily be the same salary you would pay yourself because you're wearing 10 different hats. So you're kind of the sum of all these different jobs. Anyhow, S Corp ultimately is a way to minimize the self-employment tax, and creating a holding company usually makes the most sense.
Real quick on that, because I don't want to glaze over that too quick. Because I think that's something that most people, at least most business owners, don't recognize and understand. It's something I definitely did not understand until we had this conversation, which is essentially, even though you are the owner and you are the founder, or your technical title is CEO, at the end of the day, you're doing a lot of things that are not CEO tasks, right? Like you're managing people, right? You're answering emails, right? Like you're doing more like HR. You're doing more things that are almost more like admin related style tasks. And sort of what Dan's saying is that at the end of the day, you can do and I forget the name of the term, is it a compensation study? Or
reasonable compensation study.
Reasonable compensation study to essentially look at, where do you allocate your time, and then come up with what the proper salary would be given those allocations of your time and the different activities you do. And in most cases, the actual compensation that would be reasonable for given that all those sort of bucket of tasks is far less than what a CEO salary would be or what you're actually paying yourself. And so there's an opportunity there to save substantially on employment taxes.
Yeah, that's well said. That's exactly right. If you were to draw an organizational chart and you reflect all the hats that you wear, you'd have 10 to 15 on average, because you've got HR stuff and accounting things and sales and marketing and so on and so forth, right? And then there's the actual kind of core job of running your e-commerce store. And the reality is that for those other jobs, the HR, etc., if you were to compare yourself against someone who their full-time job is being an HR director, on a scale of 1 to 5 on competency, you could probably argue you're a 1 or 2. At least that's my case. And so the relevance of that is that the lower the competencies, the lower the salary. And the pay rate for doing accounting stuff or HR or general admin or answering emails, that's going to be less than what you're going to pay a CEO. So basically, your reasonable comp is the sum of all of these individual jobs.
Hey crew, just a quick interruption to ask if you like what you are hearing and want more. Perhaps even a weekly digest of what's working today in the world of e-commerce. Every week, our team of strategists compile a single email with growth strategies and operations tactics gleaned from our work with and analysis of today's top performing brands. Think of it as the brand operator's cheat sheet to keep you ahead of the curve and ahead of the competition. Just head over to thecommercelab.com. That's thecommercelab.com to sign up.
Yeah, I think that's something that most owners don't know. And in the most important piece of all of this is that the employment tax you save is substantial. So I think that's a huge opportunity that every person listening that owns their own business should do a reasonable compensation analysis to see if there's an area to save taxes there.
Yeah, consistently when we do these and we model these out for 7-8 figure businesses, the savings is $20,000 to $50,000 per year, and it goes up the more that you make.
Yeah, that's incredible.
It's like often we do this analysis and it's like, hey, that car you said you wanted to buy, here's the money. Just buy adjusted. You're still going to get paid the same. It's just you're going to get more in draws.
Yes.
So I'm not saying take less money. I'm just saying convert what you're taking as a salary to draws.
Yep.
An alternate scenario is if you've something called a small business C corporation, and that requires you to have average assets of 50 million or less over the first 5 years. And what happens with the small business C corp is if you hold it for at least 5 years and your average assets during that period are 50 million or less, when you sell it, you can exclude 10 million in gains per shareholder from tax. So say you sell your e-commerce business after 5 years for 10 million bucks and it was a C corp that entire time, you wouldn't pay tax. You wouldn't pay any capital gains tax on that transaction, which would save you somewhere around 2.3 million.
So what are the downsides of that C corp structure, that specific structure?
Yeah, the problem with C corps is that there is a double tax. So you pay a flat tax now of 21% on profits, and then you pay a tax again on the dividends. So potentially you could be paying more tax over that 5-year period than the savings. And so really you have to model out to the best that you can how the business is going to scale and how much you're going to take out of the business during that time.
Right.
If you're not, it's significantly swayed by how much in profits you plan to take out. So if you're not taking out much in profits and just your salary, and often the C corp is overwhelmingly better because you don't have any of that dividend tax. But if you plan to take out all the profits, then it could offset all the savings from the 1202. It's called the 1202 exclusion.
I was actually having this exact conversation with 2 different brands earlier this week. One of which was aiming to consistently pull in at least a 15% EBITDA and profit every month, and then another one who was strategically positioning themselves to bring in zero. They literally wanted to, at the end of the year, not have a single dollar in profit because they wanted it all reinvested into marketing. So I think those are probably 2 good examples of where the $0 profit would be a perfect candidate for the C corp structure, right? Yeah. Because then they would not be paying that capital gains tax at the end of the day when they sell. And is there a time period? So it's a restriction where they have to be in business for 5 years. Is that correct? But then anytime after that they sell, they still don't have to pay capital gains?
You have to be a C corporation for at least 5 years. So if you were not a C corp for 2 years and then you converted and then you sold the business 3 years later, even though you owned it for 5, you wouldn't qualify because you've got to be a C corp for 5 years total.
But can you change that after the 5-year mark? Like if I were a C corp for 5 years and then change it to an S corp?
You need to be a C corp when you sell it.
When you sell it. Gotcha. Okay. Very cool. That's fascinating. And again, something I think most people don't know. So if you're and again, let's be honest, most founders are aiming for some sort of liquidity event, some sort of sale. So if your game plan is to operate at near break even and until you sell, that's a pretty incredible benefit.
Yeah, I will add another wrinkle to this, and this gets pretty complex. But if you're an LLC currently and you convert to a C corp and then you wait the 5 years, the exclusion could be more than 10 million per shareholder. So it's actually the greater of, in that scenario, 10 times fair market value or 10 million per shareholder. So as an example, we have a client that is an LLC that we're converting to a C corp, and their actual exclusion based off the fair market value currently, I think, is more like 200 million.
Wow. That's incredible.
So there is some strategy that comes into play here on if you're an existing LLC on how we might convert you to a C corp, the timing of all of that based off of the value of your IP, and of course your willingness to hold it for at least five years.
Very cool. And just so I'm understanding too, what's the hold it for 5 years? What's the tax you pay? Do you pay zero capital gains? Do you pay any tax on the sale?
So you look at the total gain and then you get to subtract this exclusion, which could be 10 million per shareholder, or it could be 10 times fair market value when you converted it from an LLC.
Understood. Okay, cool.
So a little bit more math there, but I'm just trying to simplify it to not nerd out on.
That makes sense. So it's still something to look at. And obviously I'm not a tax professional, so talk to a tax professional, but some very cool opportunities. All right, Dan, what else should we be looking at for tax savings?
So one of the fun ones, if you're an S Corp or C Corp, is the Augusta loophole. Augusta loophole comes from the Masters golf tournament in Augusta, Georgia. I think some good lobbying efforts years ago. So during this golf tournament, people are renting out their homes. So effectively, what the tax code got adjusted for was that you could rent your home out up to 14 days per year, completely tax-free. Regardless, it doesn't matter how much you collect in rents. And so that created this Augusta loophole. And basically, the business can rent your home from you up to 14 days per year, tax-free. For things like board meetings, there's a good example where if you're having it at your house, which often is the case, or you're having some sort of business meetings, the business could rent from you your house based off fair market value. And fair market value would be what would a local conference room cost you to rent, which is usually not cheap, depending on where you live, $500 to $2,000 to $3,000. So you can do that up to 14 times per year. And essentially the way it works is that the business pays you rent, the business takes a tax deduction for that, and then the money goes to you. So effectively you're taking out tax-free money from your business.
This is probably my favorite of all of the sort of the tax saving strategies, and I love that it's called the Augusta loophole. But yeah, this one's very cool, and again, this is something that this is something any business can qualify for, right?
You have to be a corporation, so S Corp or C Corp to qualify.
Gotcha. Okay, cool. So you have to be an S Corp or C Corp. Very, very, very cool. So again, another way that, look, if you're already running board meetings, which you should be, right? Having those board meetings and essentially renting out your home for those board meetings is a great way to sort of take advantage of this and be able to pull money out of the business tax free.
That's right. So if you run through an example, you figured $2,000 times 14 days, that's $2,800. And if you're in the 40% tax rate with, so you're basically the upper end tax rates with all the other Medicare surcharges and all that. In that example, you get $28,000 out that goes to you, and you save $11,200 in tax.
It's pretty cool. So kind of some of the stuff we're talking about already, like if you look at that, and I think the sort of the two lowest hanging fruits would be sort of the compensation, the reasonable compensation, study and analysis, and then the Augusta loophole. With those two alone, if you're operating, a 7-figure brand, you're talking about probably anywhere from, 30 to 70,000 to just pure cash, right?
Yeah. And what I love about these is that it usually doesn't really change. You're not doing anything different. It's not like the Wayfair ruling where now you have all these additional responsibilities and you're weighing, is the effort really worth this additional money? With reasonable comp, you're just shifting how much you're taking in draws versus salary. And hopefully you could just completely automate that. Payroll fairly automated, and you could automate your ongoing draws if you wanted. So not really any incremental additional effort there other than just like getting it set up. And then Augusta loophole, chances are you're already having these meetings or these things that are happening. We just need to document it and then reclassify draws or distributions that you're taking to rent expense.
So that's awesome. Anything else on the tax side that you would recommend?
So there's some low-hanging fruits. There's the administrative home office. That's where it's a little bit different nuance than just a traditional home office. The idea is that this is sort of where you're doing, it's sort of your primary office as a business owner. Relevance of that is that any travel you do from your home becomes deductible. So mileage from your home to the business, flights, all of that. So in addition to taking a portion of your home operating expenses. So that's a low-hanging fruit. That's often another $5,000 to $10,000 in reimbursements. Travel per diem is commonly not known about. But basically, at the end of the year, we can deduct the greater of what you actually paid or per diem rates that the IRS publishes based off geographic location. So we can actually look and see, you spent $50 on meals while you're in New York per day, but the New York per diem is 125, so we can take the greater deduction of 125, just as an example. So there's some low-hanging fruit there of additional deductions. Depending on how you've structured your business, if they're primarily independent contractors, you don't really have any employees, you can set up a solo 401k. The nuance there is that with the solo 401k, you can, as an employee, contribute 19 grand, and then the employer can put in another 37,000 in profit sharing match, which is a deduction the company takes, and you get that money. So you could actually put aside more like 56,000. That's in the scenario where you don't have a bunch of employees, where you'd have to provide that benefit to them. So just firing off some low-hanging fruit stuff here to consider. Let's see, what else? Backdoor Roth. Usually people have stopped putting money into a Roth because they're worried they're making too much money, but you can actually still put in another $6,000 per year through this backdoor Roth. A few mechanical things you have to do there to make that happen, but pretty painless. So those are a few ideas or things to kind of think about that are low-hanging fruit that you just kind of stack up, and with limited effort now you've got 30 to 100,000 in tax savings. That's every year. And if you reinvest that savings, that's where I'm sort of this proponent of this idea of a barbell, where on one side you've got kind of this boring stuff that you're doing. The other side is the home run. The home run is your business, and at some point selling it for hopefully some large multiple. And then there's the boring stuff where you're taking the savings or some portion of your income and you're putting it in things that get you an ongoing rate of return. So if we could somehow take this additional tax savings and put it into something that gets a consistent rate of return, it's just sort of that Warren Buffett saying of how compound interest, I think it was compound interest is the eighth wonder of the world or something.
Right. Something like that. But it's essentially money that, right now is being, paid to the government, state and federal. But this idea that there's, technically this is your money, right? This is money that, per the tax law, you can, pull back for yourself. And then, kind of what Dan's saying is being able to take that, push it aside and put it into, a sort of, you think of it as a barbell approach. On the left side, you've got your sort of big venture that you want to have a big win with. And on the right side, you've got your safe investments that are more sort of long-term planning. You take these tax savings and apply them, into whatever it may be, S&P 500, et cetera, over time. That's money that didn't exist before. That's now compounding, into infinity.
That's right. Yeah. So if we just took an example here, if we had 50,000 in savings and we just had a boring S&P rate or average return of 9.8%, and we put aside 50 grand per year for 25 years. So every year we just take the savings. That would be 1.25 million that we set aside, but with compound interest, that would be 5.3 million.
That's incredible.
And if we added another 10 years to that, it goes from the 5.2 million number to 14.3 million.
Just from tax savings.
If we're just taking that tax savings and putting it into a boring rate of return. Yeah.
Yep. That's very cool. And this is all, and again, the idea around this conversation is that everybody listening here is most likely operating at least a 7-figure business. And, finding 50,000 in tax savings is probably not that hard to do.
No. Yeah. On average, I mean, that's sort of the floor.
Yep.
Start looking at these 7-figure businesses of 50 grand or more that's just being left on the table because they simply didn't know that these things existed, or they're just small incremental shifts. Like we're just shifting some of your income from payroll to draw. We're shifting some of your draws to Augusta loophole reimbursement or administrative home office reimbursements. Just like these little things that then add up. And then we have the home runs like the 1202 exclusion where you exit your business and you don't pay tax on it. Like, we still want to have those, of course, but we also want the quick wins that just kind of compile.
Well, this is awesome, Dan. I think this is I think this is probably gonna be pretty eye-opening for most owners who are listening to this. I know it was for me when I sort of first talked to you about a lot of this. So thank you for sort of bringing all this up. Anything you want to close with? Anything that you think, if you're a seven-figure e-com business owner, things you should be considering or things you should be doing with your taxes or your financials that what you see most owners not doing. Any sort of last recommendations you'd leave for us?
So the data is overwhelming here that people hate tax and accounting. There was a study done by a nonprofit that found that they asked business owners, what's the thing you hate the most about running your business? And overwhelmingly, it was tax and accounting. Like, this stuff isn't fun to talk about. We let off with the Wayfair discussion, and it just sounds like, oh, this is more stuff I have to do when I already don't have time. And so I'm just a proponent of let's get a plan in place, some sort of roadmap, and make this stuff that as systematic as possible. In other words, let's move it from something that seems overwhelming to something that's automated and that you don't have to think about.
I love it.
So that's my thought process. Is anytime you're faced with something that on the surface seems awful or that you don't want to do, my head just goes to like, how can we automate this? How can we come up with a plan and move it off so that you don't have to think about it?
So Dan, where can people find you? Because I know probably the first question I'm going to get from folks is going to be, okay, this is great, but like, now how do we execute this? Right. So I think some of it's going to be, hey, if people want to talk to you further about this and how it applies to their business, I would love to know where they should find you, but also just like, what's the best next step? Like, if people are hearing this, they're saying, okay, I think we can take advantage of this at our company. What's the next thing they should do?
Yeah, there's two ways that folks can reach me. They can just go to our website, which is Nth Degree CPAs.com. So they can go there and there's a link to schedule some time to chat. Or we do basically a weekly office hours. And then we've got a website for that, Wealth Q&A, as in Q and the letter NA.com. So if you're like, I'm not necessarily ready to do a plan, but I've got some ongoing one-off questions, basically once a week, I get on and I teach something, whether it's tax strategy or financial principle or way to make decisions or set up strategies. You can just jump on wealthqa.com and sign up for our weekly office hours.
That's awesome. All right, man, this was fantastic. Thanks for coming on, Dan.
Yeah, thanks for having me. Always a pleasure to chat.
Hey crew, it's Alan Bird again. And real quick before you go, would you like a weekly digest of what's working today in the world of consumer-facing e-commerce? Every week, our team of strategists compile a single email with growth strategies and operations tactics that help you stay ahead of the curve and ahead of the competition. Think of it as the brand operator's cheat sheet. Just head over to thecommercelab.com to sign up.